Today we have an interesting discussion about the ideal share of equities in your portfolio. People often ask, how much should I invest in equity? Let me tell you a famous thumb rule that has been around for many years, and that's called 100 minus age rule, which means that from your disposable income, the percentage of funds which should go toward equity investment is 100 minus your age. Say for example, your age is 30, then 100 minus 30 equals 70, which means 70% of your disposable income should be invested in equities. Note that we are referring to disposable income, which means the money left after your liabilities, basic necessities and expenses are deducted from your net income. So essentially, what this thumb rule tells you is that if you are of 30 years age, you need to invest 70% of your disposable income in equities for a better retirement and wealthy life. If you are 60 years old, 100 minus 60, that is 40% can be invested in equities, the rest 60% in debt instruments. The thumb rule of 100 has been a helpful starting point for many investor asset allocations in the past. But let me tell you that there are two factors which put this thumb rule into question. The first factor is inflation and low interest rates. I hope you understand what inflation is. It is simply the decline in purchasing power because of the rise in the prices of goods and services. Let's quickly look at some statistics. In India, the inflation stood at 5.52% in March 2021 compared to 5.03% in February and 4.06% in January. Over and above this, it is estimated that a rise in US inflation could also affect India adversely in the coming months. Rising inflation is any day a serious threat to common people. Even if we don't worry much about the short-term fluctuations in the inflation rate, we can see how the value of rupee has fallen down over the long term. 100 rupees in 1958 is equivalent to 8,416 rupees in 2021. There is a decline in the interest rates. In the 1990s, the interest rates were at 11 to 13% levels. Now, in 2021, the rates are at 5.5 to 6.25%. This essentially means that the yields from fixed deposits are stubbornly very low. Hence, rising inflation and decline in interest rates continue to be a major challenge for the investors. The second factor is that our life expectancy has increased. This means that we are going to live longer and we may need more money for our retirement planning, isn't it? Let's take a quick look at the increasing life expectancy from the year 2000. So, in order to have a desired lifestyle, the rule of 100 may prove to be too conservative to plan for our retirement. So, there is a tweak suggested to this 100 thumb rule, and the new 100 is 120. Which means that It's now 120 rule of thumb. For example, if your age is 30, 120 minus 30 is 90, which means 90% of your disposable income can be invested in equities. If your age is 40, 120 minus 40 equals 80, which means 80% of your disposable income can be invested in equities. I know this idea sounds aggressive, but let me tell you why you need to up your equity investments. Believe it or not, more allocation towards debt instruments can be the single most impediment towards achieving your retirement investment goals. Agreed, the experience of the Great Recession in 2008, many more stock market crashes and scams made many of us risk averse. However, we as investors really suffer a lot by staying out of the stock market or by making excessive allocations towards debt instruments which don't take care of the inflation aspect. In fact, a recent Wells Fargo retirement study found that 60% of the investors focus more on avoiding loss through stock markets rather than compounding the growth of their investments in the market. This conservative stance is sure to make an irrecoverable dent to your investment goal. Hence, I personally like the 120 thumb rule. But, as is the definition of a thumb rule is just a guideline that helps you in a more practical way. There are definitely certain theoretical limitations. Like, for example, this rule doesn't take into account your risk profile and other commitments. Let's say we have two people, person A and person B. Person A has a working wife, only one kid, and no debt. Person B is the only working person in his family, has two kids, and an expected cash commitment towards his sister in the 10th year from now. Both are aged 30. Now, if we applied this rule of 120 to both of them, person A should put 90% of his money in equity and person B also should put 90% of his money in equity, which is definitely not appropriate and fair, as person B has a lot of other commitments and he does not have a backup of second salary in case he loses his money in equity. So each person and his risk profile is unique. This thumb rule is a general guideline and also, more importantly, this rule assumes that the equity investments are intended for long period, maybe 20 years. If you follow this rule for just short term like just 1 to 5 years, I am sure you will be in big trouble. Equity investments have to be thought of as persistent long-term commitments. For example, we know that Sensex has delivered returns to about 390 times since its inception 39 years ago. That's a whopping annual return of 16%. Then, why is it that as an individual investor, we are not able to make such a pretty return on our investment? That's because handsome returns come to investors who stay the course for long periods. But think of this for a minute. How many of us have the patience and determination to stay invested for 39 years? Or at least 20 years. And how many of us have the nerve and maturity to handle short term market crashes? How many of us have serious confidence in our indices and stay invested? How many of us withstand the temptations of panic selling and quitting early? If you're not one among those lot and your family situation is okay, then there is no doubt you can embrace the rule of 120. Let me close this discussion with the famous Warren Buffett's words to his shareholders in 1996. If you are not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Time is a friend of the wonderful business, the enemy of the mediocre. So, if you're young, invest more in equities and give it proper time for compounding. Avoid short term investing, and this rule will fetch you great results.